Will then like to invite Mr. Bruno to come to the stage by the time he is doing so, to make a presentation at this time. And his presentation is under the agenda item 2, where we are looking at the implications of mobile money for regulators. So while he makes his way here to the podium, what I will do is just share with you some information as to who this gentleman is. Mr. Bruno, Michael Bruno, is the Executive Director of Digital Products and Services at one of the largest banks in Haiti, SOGEBANK, a newly created position where his job is to spearhead the initiatives of the bank for digital banking. Prior to joining his bank, Mr. Bruno has introduced the first cross-border mobile remittance service in Haiti in 2013. As the country's manager for Boom Financial Incorporated, a California-based startup offering a digital alternative to money transfer services in Latin America and the Caribbean. Within 1 year, the startup was processing over $200,000 per week in the Florida-Haiti corridor. Bruno's extensive mobile financial technology background stems from his role as Senior Technology Advisor for Haiti Integrated Finance for Value Chains and Enterprises Project, a USAID-funded project. Under this institution, he spearheaded the efforts of introducing mobile technology in the financial sector in Haiti. Bruno was instrumental to the partnership between USAID and the Bill and Melinda Gates Foundation, which resulted in the creation of the Haiti Mobile Money Initiative. That facilitated the launch of 2 mobile money services on the Haitian market, 9 months after the earthquake, shaking a financial sector that has been stagnant for some years. Mr. Bruno also conducted various mobile money consulting in Africa, namely in Kenya, Burkina Faso, and made various learning trips and appearances in conferences in more than 15 countries worldwide. He has a combination of experiences in the private sector, international organizations and NGOs, and is in the public sector as a consultant. Could you warmly welcome Mr. Bruno as he presents to us this morning, please?
Thank you. Good morning again. I hope that you have not been bothered with the second presentation again of myself this morning. This morning we're going to discuss about regulation and digital financial services in general. I didn't make a presentation per se because I thought that I was going to be in the panel discussion only, but I've taken some notes and obviously from what I've been through in regulation, I can surely discuss about that with you. So we're gonna address different aspects of regulation for digital financial services. The first one is usually the regulators define what types of institutions are allowed to provide financial services, either mobile money or today we're talking about blockchain. So this is the first area where usually there is a lot of debate. Some jurisdictions allow non-bank entities to offer a subset of financial services like virtual wallets, mobile wallets, electronic money in general. In some other jurisdictions, they say this is still banking. So as, for example, the governor of the central bank in Haiti says the fact that you're using now different technology doesn't change the nature of the activity, which is still banking. So depending on the jurisdictions and on the philosophy of the central bank there, you might have an environment that is conducive to innovation, and you might not. One of the examples that we take often is the Kenya example, where basically Safaricom has been allowed by the Central Bank of Kenya to offer mobile money services. They are being supervised directly by the central bank, and basically this allowed them to have, all the margins that they needed in order to offer that kind of service. In the Latin American region in general, central bankers in that region tend to believe that traditional financial institutions need to have a bigger role to play. So that's why, for example, in the context of Haiti, the decision of the central bank in September 2010 was to say that only deposit-taking institutions can actually offer these types of services, which means commercial banks and credit unions. If any third-party company, non-bank entity wants to offer such services, they have to partner with a bank or a credit union in order to offer that service. And everything that happens in terms of liability of the operations and all of that fall on the shoulders of the financial institution. So this is one area where I think we need to be careful, because basically by taking such decision, what we call in French, the rapport de force has changed, because now the banks have leverage on the technology companies in terms of negotiations in order to provide such services. Personally, I was not able to launch certain features because the bank that I was working with, or in that case, the credit unions that I was working with, did not approve those features, or I was not able to interoperate with another provider because the respective financial institutions could not agree on a settlement process and a commercial agreement. So these are the types of, if we really, what we want in an economy, if we really are we're looking at the interests of the consumer, is to make sure that there is enough competition on the market so that people work to provide more efficient solutions, to provide better prices, and make sure that we do not create a monopoly or an oligopoly in a certain sector. So I think that we can have comprehensive regulation that cover full-fledged financial services like banking, but also entities that are only doing a subset of these activities, like providing only a payment service, that they do not have to fall under the most stringent regulation that a traditional bank has. So these are the types of, in some countries I've tried to do that. For example, Mexico, I think, has a very comprehensive approach to that. Brazil also allows you to have different types of institutions that can offer different types of services. So there's no one size fits all. We need to look at those areas in terms of when we want to regulate these kind of services in our economy. The second aspect in mobile money is, usually when we talk about mobile money, we also see financial inclusion. And we want to go after a group of people that have been traditionally excluded from financial services or are underbanked. And very quickly, we fall into the KYC requirements for such customers. Traditional banks require like 2 pieces of ID, proof of address, and all of that in order to create an account for these people. And often, in certain countries, the vast majority of people either do not have two pieces of ID, or there's no way they can provide a proof of address, because of, it's not like they are in a developed economy where each address is identified and everything. So this makes it difficult to sign up these customers when we have such rules. I think that most central banks have made some progress in allowing to have a lighter KYC requirement that is matched with lower transaction limits in order to mitigate the risk for these customers. And I think that generally this is an approach that we are seeing very often now. Now, I would advise not to go too far, because there is some point where facilitating the opening of accounts become counterproductive. Like the example I showed you yesterday, where some people could stay at home, take their phone and just type star 102 star something DS, and then they are registered, they have an account anonymously. At the second step, they just had to provide their date of birth and their name, which is you can make up this information when you create it. So, and that was it, and you had your account. Of course, you had a very low limit in terms of the balance that you are allowed to have in this account. However, we have seen after 2 years that most of the probability of these people to stay active is very small. And the fact that people could just do it because it's free, it doesn't require any effort, just by curiosity, they can just create accounts like that. I think that we had gone too far, which is one of the reasons why many accounts had to be closed afterwards, because they were basically accounts that have stayed inactive. So we need to have the right balance on how easy it is to create an account, mostly because we want to make sure that the person that is signing up is educated, they know what the product is about, and they understand what they're getting into. And on the side of the provider, usually there's a cost of maintaining these accounts. So we want to make sure that the people that are signing up are really signing up because of the interest that they have for the service, and so forth. So I think that in one hand, we need to advocate lighter KYC requirements. For example, in our case, we only require one piece of ID, and we don't require proof of address. And there's other ways to build a profile of the customer using customer analytics, so which is dynamic, because basically when you do KYC, you identify the customer at time T, but the profile of the customer changes over time, and we need to use customer analytics and collecting data on the behaviors, and use probabilistic mechanisms in order to continue to monitor the risk for that customer, and not relying on the KYC that we do at point T and then have a false sense of security. When I signed up for my first bank account years ago, I'm pretty sure I'm very different from what I was at that time, but I've never updated that information, basically. So just collecting information at sign up is not enough. We need to build the profile through data analytics and data mining, customer, probabilistic approach throughout the life cycle of the customer, to really strengthen the security of our services. So I think that these are the main areas in terms of the regulation. And the third one, maybe and last, would be how to enable the development of ecosystem around financial services, so that third-party companies, developers usually, that are not necessarily financial institutions, that are not the core providers of those services, can build value-added services for specific industries, but tapping into the system of payments that the financial service providers are providing to increase the value of and to meet the specific needs of the customers in the Caribbean economies. So I'm gonna stop there to allow more participation in questions. So thank you for your attention this morning.
Thank you very much, Mr. Bruno. You could please join us here at the table.